So now we are going to study more on fundamental analysis and technical analysis, which are important components in the stock market. Now, fundamental analysis looks at a company's financial health, management, industry trends, and economic conditions to find its intrinsic stock value. It emphasizes long-term performance factors, and technical analysis examines past price and volume data to spot trends and predict future movements with charts and indicators. Investors often combine both fundamental analysis and technical analysis to make better decisions. They are thus called complementary approaches. Now, what are stock indices? Because they are the main drivers or the main components in the stock market. Stock indices are a measure of the performance of a group of stocks that are representative of a particular market or sector. Now, they provide investors with a way to track the overall performance of the stock market and can be used as a benchmark for individual stocks portfolios. Stock indices are often used to gauge the health of the economy and can be an important tool for investors to make informed decisions about their investments. There are many different stock indexes or indices, each tracking different segments of the market, such as the S&P 500, Dow Jones Industrial Average, and Nasdaq Composite. Then, understanding stock indices can help investors better understand the broader market trends and make more informed investment decisions. Now you can go through this and see that Nasdaq Composite is a market index that tracks the performance of over 3,000 stocks listed on the Nasdaq Stock Exchange, including many technology companies. Then S&P 500 is a broader based market index of 500 largest US publicly traded companies, representing about 80% of the total US stock market capitalization. Dow Jones Industrial Average is one of the oldest and the most well-known US stock market index, tracking 30 large blue chip companies across various industries. Russell 2000, a small cap stock market index that measures the performance of around 2,000 of the smallest US publicly traded companies. Now, investing strategies for beginners. So, investing can seem overwhelming for beginners, but there are some simple strategies to get started. One approach is to focus on long-term investing, which involves buying and holding onto assets for an extended period of time. This strategy can help minimize the impact of short-term market fluctuations and potentially lead to greater returns over time. Another strategy is to diversify your investments across different asset classes to spread out your risk and maximize potential gains. Additionally, it's important to do thorough research and seek advice from the financial professionals before making any investment decisions. Now, there are others as well, like dollar cost average, which is investing a fixed amount regularly regardless of market conditions to smooth out the impact of price fluctuations. So we commonly call it SIP, which is also utilized in the mutual fund arena. So these are some of the strategies for beginners, and of course the beginner is advised to start small. Begin with a small amount of capital to test different investment strategies before committing larger sums. Now let's gain deeper insights into the finance markets and the financial landscape. we'll start by unpacking the concept of market capitalization again, which we have already touched earlier, a key metric for understanding the size and the value of companies. From there, we'll explore the dynamics of bull and bear market, which also we have touched earlier, and how these market conditions influence investment strategies. So, market capitalization is a comprehensive metric that provides a holistic view of a company's total value. It factors in both the current stock price and the number of outstanding shares. This metric reflects investors' sentiment and confidence and is often used to gauge a company's size, stability, growth potential, etc. Market capitalization allows for easy comparison of companies within the same industry or across different sectors. This makes it a useful tool for analysis and benchmarking. Understanding company's market capitalization is thus very important to know about its position and potential in the broader market landscape. Now, dividends also we have covered briefly earlier, and we'll again touch upon it. Dividends provide investors with a regular income stream, offering a tangible return to their investment or on their investment. Dividends can be reinvested to compound returns over time, enabling investors to grow their wealth. A company's consistent dividend payout often indicates financial strength and stability, which can attract long-term investors. Dividends are an important consideration for investors looking to generate income and build wealth through their portfolio. Now, these are again certain basic yet important indicators to study a stock. The PE ratio, which is valuing the future. Now, the PE ratio is a metric that compares a company's current stock price to its earning per share, providing insight into its valuation. A lower PE ratio may suggest a company is undervalued, while a higher PE ratio would indicate expectations for future growth. Analyzing the PE ratio can help investors make informed decisions about a company's potential for long-term success. Now, this ratio, as explained, is useful for evaluating companies' current valuation and prospects for future growth. Considering the PE ratio along with other financial metrics can give investors a more complete picture of a company's overall health and investment potential. Now, volatility is a measure of the degree of fluctuation in a stock price over time, which allows investors to gauge the level of risk associated with the investment. Analyzing patterns in market volatility can help investors identify potential opportunities and make more informed trading decisions, as volatile assets may present chances for higher returns. As the more movement there is, a larger move you can expect, larger gains as well if you are in the correct trade. Incorporating volatile assets into a diversified portfolio can potentially enhance overall return, while also helping to mitigate the risk associated with market swings. Investors can use tools like options to manage volatility and protect their investment from significant market fluctuations, employing hedging strategies, as we call them, to minimize downside risks. Now, bulls and bear markets are basically the cycles in a market: bulls, bears, and range bound. So a study of these is very important. And bull markets are periods of rising stock prices, optimistic investor sentiment, and often driven by strong economic performance. Bear markets are periods of declining stock prices and pessimistic investor sentiment, typically caused by economic downturns or negative sentiment. Understanding the cyclical nature of bull and bear markets can help investors adapt their strategies and manage risk. Now, recognizing the current market cycle is crucial for making informed investment decisions and positioning your portfolio appropriately. Paying attention to economic indicators, investor sentiment, and market trends can provide valuable insights into the current phase of the market cycle. Adapting your investment approach based on prevailing market conditions can help you navigate the ups and downs more effectively. Now, blue chip stocks are shares of the large, well-established companies that have a long history of stable performance and reliable dividends. These stocks are generally considered to have a lower risk profile compared to more volatile, smaller companies, making them a more popular choice for risk-averse investors. While blue chip stocks may not offer the same rapid growth potential as smaller companies, they often provide steady, long-term returns for investments looking for stability and reliability in their portfolio. Now, these companies have built strong, reputable brands and have the resources to weather economic downturns, providing a solid foundation for long-term investment. An IPO, as we had discussed, or an initial public offering, is when a private company sells shares to the public for the first time, allowing it to raise capital. This opens up the companies to new investors who can now own a piece of the business. And going public also increases the company's liquidity, making it easier to trade shares and access capital markets. These are some of the key benefits and motivations for a company to pursue an IPO. I'll now dive into each of these points in a bit more details. So, like an IPO allows a company to raise capital, and also it gets listed, it gets equity funding into their operations. So there are equity funding, there is debt funding, there is bond funding which comes under debt again. So this is the part which will cover the equity funding. Now, what are ETFs? ETF stands for Exchange Traded Fund, which offer investors a diverse range of investment options, providing instant exposure to a wide variety of assets. This diversification can help reduce risk and volatility in your portfolio. ETFs typically have lower management fees compared to actively managed mutual funds, making them a more cost-effective investment option. ETFs can be traded throughout the day like stocks, giving investors greater flexibility and control over their investment. The combination of diversification, cost-effectiveness, and liquidity makes ETF an attractive investment choice for many investors. What are index funds? Index funds provide a broader exposure to the market by tracking specific market indices, giving investors access to a diversified portfolio of securities. One of the key benefits of index funds is their low management fees compared to actively managed funds. This helps maximize return for investors. Index funds follow a passive investment approach, aiming to simply match the performance of the underlying market index rather than trying to outperform it through active stock selection. Now, this order types we have already covered. So market orders are executed immediately at the best available price in the current market conditions. Okay, and then limit orders allow investors to set a specific price at which they are willing to buy or sell a security. This gives more control over the execution price. Understanding the differences between market and limit orders is key to tailoring your trading strategies to your needs and risk tolerance. And limit orders can help manage risk by controlling the price at which trades are executed, which is especially useful in volatile markets, because in volatile markets, if you want to buy something at X price, then the rate that you get will be based on whatever is the available price going at that time. It could be high, it could be low, anything, and there is sometimes very large spreads that you are susceptible to. Now, short selling is basically profiting from declines. So short selling is a trading strategy where investors borrow shares of a stock they believe will decline in value, and then sell those shares with the intention of buying them back at a lower price later. The process involves first borrowing the shares, then selling them at the current market price. The goal is to repurchase the shares at a lower price in the future, pocketing the difference as the profit. However, short selling carries significant risk. If the stock price rises instead of falling, then the short seller can face unlimited losses as they are forced to buy back the shares at a higher price. So short selling requires careful analysis and risk management. It's important to thoroughly research the company and have a strong conviction that the stock price will decline. So margin trading, another word for leveraging investments, allows investors to borrow funds from a broker to purchase securities using their existing holdings as collateral. This can potentially magnify investment returns, but also carries increased risk due to the use of borrowed funds. Investors using margin accounts must maintain a certain level of equity and may face margin calls if the position declines in value. Margin trading can be a powerful tool, but requires careful management to avoid significant losses. So we'll come back with more on stock splits, which enhance the liquidity in the stock markets. So we will understand what stock split is. A stock split is a corporate action that divides companies' existing shares into multiple new shares, adjusting the stock price accordingly. Stock splits can make a company's share more affordable and accessible to a wider range of investors, increasing trading volume and liquidity. Stock splits are often seen as a positive signal indicating a company's growth and management's confidence in the future. By enhancing liquidity and accessibility, stock splits can contribute to an increase in a company's overall share value. Market corrections are a natural part of investment cycle where stock prices adjust to reflect underlying fundamentals. During corrections, we often see a shift in investor sentiment from optimism to a more cautious, pessimistic outlook. However, these periods of market volatility can also present opportunities for savvy investors to identify undervalued stocks and position themselves for future growth. It is important to understand the drivers behind market corrections, such as overvaluation, in order to make informed investment decisions. By weathering these adjustments, investors can better position their portfolios to capitalize on the market's long-term upward trajectory. Now, we will discuss a bit about buying stocks for the first time. And investing in the stock market can be a great way to grow your wealth over time, but it's important to understand the risk and do your research before getting started. The stock market can seem intimidating, but with the right knowledge and preparation, anyone can become a successful investor. And we will cover the key things to know when buying stocks for the first time, from understanding market basics to developing a smart investment strategy. And you have to keep your eyes and knowledge wide open. Means you need to research thoroughly before investing. Don't just blindly put your money in Understand the stock market and the risk involved. Avoid investing just because your friends made money. Make sure you understand the market and the potential risk first. Investing in stocks carries risk, so it's crucial as a beginner to be aware of and understand those risks. And let's just cover a few more important basic things like key financial terms, you can say, like 52-week high and low. Then the previous close, or they provide a solid foundation for understanding the market, because these are key levels which were generated during the volatility and the movement of the particular stock. Then learning important financial ratios even at a high level will help you interpret company performance and health. Building investment knowledge and skills takes time. Start with the basics and gradually expand your understanding. Mastering the fundamentals is crucial before moving on to more advanced investing concepts and strategies. So it's a stage by stage learning process. Accordingly, invest wisely. Do not jump into the markets in a very aggressive manner. Now, as a beginner, it's important to only invest surplus funds that you can afford to lose. Don't risk money that you need for essential expenses. Avoid the temptation of quick profits in the stock markets. The market carries risk, so don't expect to get rich quick. Start small with your investments and gradually increase as you gain more experience. A cautious approach is best when you're not new to investing. Never risk money in the stock market that you can't afford to lose. Protect your savings and only invest what you're comfortable potentially losing. Now, what do you mean by listen and don't follow? It's focused on avoiding blindly following others' investment decisions and instead doing your own research and developing a personalized strategy. The first point is about not just investing in stocks because someone else has done so. You need to avoid that blind following mentality. The second point emphasizes the importance of thoroughly researching a company, even if it's your popular investment choice, before putting your money into it. The final point is about developing your own unique investment strategy based on your specific financial goals and risk tolerance rather than just copying what others are doing. Now, diversification is key to managing investment risks. By spreading your investment across different companies and sectors, you can reduce the impact of any single investment underperforming. And it is important to consider your individual risk appetite while deciding on your investment mix. If you have a higher risk tolerance, you may want to allocate more to riskier assets. If you are more risk averse, a more conservative approach may be better. Avoid putting all your money into a single investment or asset class. A balanced portfolio with a mix of different investments can help provide stability and reduce overall risk. Now, greed can lead us to make poor investment decisions based solely on past returns without proper research. Fear can cause us to sell our stocks at low prices when the market is down, leading to losses. It's important to stay analytical and make investment decisions based on facts, not emotions. Avoiding emotional decision making and maintaining a logical approach is key to successful investing. By keeping our emotions in check, we can make more informed and rational choices with our investments. Now, the stock market is constantly fluctuating due to many factors, making it very unpredictable. Trying to time the market by buying low and selling high is extremely challenging. It's very difficult to consistently get the timing right. The best investment strategy is to focus on long-term growth rather than trying to time the market. Researching and investing for the long term is a more reliable approach. The key is to have patience and let your investments grow over time rather than trying to outsmart the market. Now we've already studied about diversifying. So basically we'll touch upon that again, that diversifying your portfolio is key to managing risk and protecting your business. So by investing in a variety of companies and sectors, you can spread out your bets and avoid overexposure to any one area. A balanced approach that allocates funds across different asset classes like stocks, bonds, and real estate can provide stability and help weather market fluctuations. The optimal portfolio will be customized to your specific goals and risk tolerance. There is no one size fits all solution. Regularly reviewing and adjusting your portfolio is important to maintain the right balance. Then the stock market will naturally experience periods of growth and decline or sideways market. This is a normal and expected part of the market cycle. As investors, it's important to stay calm and focused on a long-term investment strategy rather than getting caught up in short-term ups and downs. In fact, market dips can sometimes present opportunities for smart investors who are able to identify undervalued assets and make strategic purchases. So the key is to have the discipline to ride out the waves of volatility and not make rash decisions based on temporary market fluctuations. Seeking professional guidance from a financial advisor can be very valuable when navigating the stock market and investing. An experienced advisor can provide personalized strategies and help you develop a customized investment plan tailored to your specific goals and risk tolerance. Working with a professional can also help you better manage the risk associated with investing, providing ongoing monitoring and adjustments to your portfolio that is as needed. So the ongoing support and expertise of a financial advisor can be extremely helpful in achieving your long-term financial activities. And I would express that investing in stocks is a long-term endeavor that requires patience and discipline. It's important to have a clear long-term mindset, not get caught up in short-term market fluctuations. And consistent monitoring and staying the course are key to achieving your long-term financial goals. Now, you have to learn from your mistakes because as an investor, we all make mistakes. So we have to continuously learn and upgrade and tweak our methods around the markets. Mistakes are inevitable, part of investment journey, and the key is to embrace those failures. Like, we should not feel too much stressed when we have a losing position, because we can always improve or we can always make corrections. So each loss can teach us something valuable about our approach. After a setback or a loss, take time to carefully analyze what happened. Reflect on the decision you made and why. This self-reflection is crucial for adapting your strategy going forward. So maintaining a mindset of continuous improvement is essential, and this will only make you better, become more skilled and successful over time. Remember, the most experienced and successful investors all had to start somewhere, and embrace the learning process and don't be discouraged by occasional failures. They are simply stepping stones on the path to long-term investing mastery. And as we have already told you, that gradually increase your investment, start small and think long-term, and prepare your strategy for meeting all the market cycles. And you have to enjoy the journey, basically. Why we say enjoy the journey? Because at times this stock market investing can become little stressful, but if you have proper research and if you adapt to the markets and the strategies, keep changing and improving, then you will start to enjoy the journey. So basically, it's a continuous learning process, and it's important to celebrate the milestone along the way. Milestone means if you have reached a certain ballpark figure of gains, so you can, be happy about that, and don't let investing consume your entire life. Maintain a balance, make sure to enjoy the journey. So in the next part, we will cover more about how to invest in stocks with just a little money. Now let's learn a bit that how to invest in stocks with little money, because investing in stocks is accessible even with a small amount of money. You just need to start small and build your portfolio over time, and you need to diversify your investments, and you need to take advantage of some economical brokerage platforms. So let's learn more about it. Penny stocks are often priced low due to lack of demand from investors, but many penny stock companies are in a precarious financial situation and on the verge of collapse. It is important to thoroughly research any penny stock company before investing, rather than just being attracted to the low share price. Invest in companies you believe have strong fundamental and long-term potential, not just low price stocks. Penny stocks carry a high risk, so it is crucial to understand the business and its prospects before putting your money into it. Now, invest via zero brokerage platforms, because it allows you to invest without paying high trading fees, which helps you save money and maximize your returns. These platforms make it easy for anyone to start investing even with small amounts of money. By avoiding brokerage charges, you can grow your wealth more effectively over time. The key benefits are minimizing costs, making investing accessible, and growing your wealth through lower fees. Then invest in mutual funds, because it's a great way to invest your money, as they offer several key benefits. They offer diversification. Diversification is a major advantage, because mutual funds spread your investment across many different asset classes, reducing your risk. Professional management is another big plus. Experienced fund managers make the investment decisions on your behalf. And mutual funds also tend to be a more conservative investment approach with lower overall risk compared to investing directly in individual stocks or other assets. These features make mutual funds an attractive option for many investors looking to grow their wealth over the long term. Index funds provide broad exposure to the overall stock market, tracking the performance of a market index like the S&P 500. They have lower management fee compared to actively managed funds, which helps maximize investment returns. Over the long term, index funds have historically delivered steady, reliable growth, making them a solid choice for long-term investors. The combination of broad market exposure, low fees, and long-term growth potential makes index funds a compelling investment option for many investors. Leverage robo-advisors. We are talking of starting in a small way, which is like consistent saving is key. Set aside a small amount from each paycheck to invest regularly. So suppose you have a certain inflow, you need to just invest a small portion of it. Do not jump the gun and take out a lot of money and put into markets. Do it systematically. Make it easy on yourself by setting up automatic transfers to invest without extra effort. So over time, your investments will grow through the power of compound growth. Your money will start earning returns on top of returns. The key is to start small and be consistent. Even modest regular investments can add up significantly over the long run. Now, we would talk a bit about robo-advisors. They are a new type of automated investing service that use algorithms to manage your investments. They create personalized investment portfolios tailored to your specific financial goals and risk tolerance. So robo-advisors typically charge much lower fee compared to traditional human financial advisors. This makes investing more accessible and affordable for a wider range of people. The automated nature of robo-advisors also allows for more frequent portfolio rebalancing and optimization. Overall, robo-advisors provide a convenient and cost-effective way to get professional investment management. So, what are fractional shares? They allow investors to access high-priced stocks that they may not be able to afford otherwise. And fractional investing, so this enables building a diversified portfolio even with a small amounts of capital. Fractional investing often offers flexibility, allowing investors to put in the exact dollar amount they want rather than having to buy full shares. And this makes it easier for investors to build a portfolio they want with the stocks they want to own. Now, dividends are regular cash payments made by companies to their shareholders. Investing in stock that pay dividends can provide a steady stream of income. By investing those dividends to purchase more shares, you can take advantage of the power of compounding. Each new share you acquire will also pay dividends, and allowing your portfolio to grow exponentially over time. Reinvesting dividends is a simple yet effective way to accelerate the growth of your investment portfolio. The more you reinvest, the faster your wealth will compound. The key is to be patient and let the power of compounding work for you over the long term. Consistently reinvesting your dividends can make a significant difference in the ultimate value of your portfolio. Now, cryptocurrencies have seen tremendous growth in recent years, with many digital assets experiencing significant price appreciation. Investing in cryptocurrency can provide diversification benefits, as crypto represents a new and emerging asset class that is not highly correlated with traditional financial markets. One of the advantages of crypto is its accessibility. You can start investing with relatively small amounts of money, making it more accessible to a wider range of investors. Real estate is, of course, not part of the stock markets, but it is part of the financial markets, all right. Now, it's a tangible asset that can appreciate in value over time, unlike many other investments. Investing in rental properties can provide a steady stream of passive income through rent payments. Leverage is a key advantage of real estate investing. You can use debt like mortgage to amplify the impact of your investment. These three factors, tangibility, rental income, and leverage, make real estate a good area to invest, or a good option to invest in for many people who have a larger amount of funds available. Then you have precious metals, which like gold is a classic safe haven asset that investors often turn to during times of market volatility and economic uncertainty. Silver has a wide range of industrial applications, from electronics to solar panels, in addition to its investment demand. Platinum is a rare and valuable metal which uses which uses in catalytic with use in the catalytic converters, jewelry, other industrial products. Its scarcity contributes to its appeal as an investment. Precious metals like gold, silver, platinum can provide diversification and potential protection against inflation in an investment portfolio.